Hi, everybody. This is Chay Lapin, president of Kay Properties and Investments. In today's presentation, we are going to go over why investors choose to go passive. Why do investors particularly choose to go passive and they are exploring triple net properties? Before we start this presentation, we always like to go over the risks and disclosures. We highly encourage everybody to pause their screen and to review all the risks in full. But more importantly, we do not intend to provide any tax or legal advice via this webinar and presentation, and nor do we intend to provide tax or legal advice when speaking with investors. We highly encourage, before investing into any investment, particularly if you invest with us via 1031 exchange or direct cash investment, to speak with your CPA and legal team, as there are various nuances and risk factors that may be particular to your situation. We're here to educate you and provide you the information that you can then, again, take back to your CPA or legal team to review. So now we dig into the presentation. I always like to start with a refresher of the 1031 exchange timeframe. A lot of people that are exploring triple net properties out there are doing it via 1031 exchange. And the reason why is they're coming out of a operating asset class like a multifamily, looking to become passive and go into a net lease asset. At least that's a common occurrence that we come across when we are speaking to investors at our firm. And so a couple things to refresh in, most importantly, is utilizing an intermediary accommodator. So when you close on that asset, that you are not touching that money at all. It's going directly to the intermediary. And then that clock starts the 45-day time frame. And that's really where investors get up against the wall and having to identify something while they're still reviewing the asset or negotiating the asset. And so hopefully through this presentation, we provide different avenues of education and options that help investors through that tight time frame of the 45-day window. If you have any questions regarding the 1031 exchange, please reach out. We have a lot of information on that timeline. So now getting to the real topic here of why do investors want to be passive investors? You know, there's a lot of people out there that want to be active, and there's a lot of people that want to be passive. And passive is, hey, I want to just collect my check every month and I don't want to do the day-to-day management responsibilities. And from what we see out there is there's different types of people that want to be passive investors. There's professionals that are still highly involved in some sort of business. They're an entrepreneur, they're a lawyer, they're a doctor, and they just don't have the bandwidth or the extra hours to focus on operating a piece of real estate. As in a lot of cases, that is a full-time job, if not a part-time job. And then there's another crowd that is ultimately retired. They've managed assets for 20 to 30 years, and they are tired of the 3 T's, the tenants, toilets, and trash, and they're looking for an option to be a passive investor so they could travel, enjoy the grandkids, or whatever it may be, just having that freedom ultimately. So what are net lease properties? Net lease properties are generally a single tenant building, or it can be like a retail shopping center that has various buildings that are considered a net lease structure. But for all intents and purposes of what most investors are seeing out there, it's a single tenant building. It could be a CVS, a Walgreens, a FedEx, a Dollar General, a fast food. And usually they have a 5 to 25-year lease structure on them. So you have a large corporate tenant that's renting your building, they're your tenant, and they're signing a 5, a 10, a 15-year lease. So you have that long lease that produces income more on a guaranteed level, guaranteed to the extent of what the lease is guaranteeing, but it's a lot different than an individual renting an apartment building. And there are a lot of nuances that you want to understand on that guarantor, because a lot of people out there say, oh, you're guaranteed that money. And I will go over different case studies on this webinar. And, you know, if you want to reach out where that guaranteed money on the net lease property wasn't so guaranteed, but it can be arguably much more secure than an individual signing a lease if you have a very strong guarantor on the lease. But there are nuances that can even cause a very large tenant to not pay the rent. And so you just want to understand those pros and cons. There are also different kinds of lease structures out there that we'll dig into: the triple net, the double net, the single net. And so on those different structures out there, you could be being presented that it's a triple net property, but there could still be a level of management responsibility. So what are the potential benefits of net lease properties for investors? As we mentioned, passive income, the potential for stable cash flow, a predictable return, a lower management burden, maybe not 100% passive, like I said, but a lower burden than what you might have experienced on your multifamily deal. So when you're looking at net lease properties, there's kind of two common terms out there when you're looking at tenants. There's a credit tenant and there's a non-credit tenant. A credit tenant is going to be a well-established national retail, bank, government agency, some big corporation. Again, that could be a CVS, it could be a FedEx, it could be a Dollar General. And then a non-credit tenant is maybe a private company, a local business, it could be a franchisee. So even though you're buying a Carl's Jr., it could be a franchisee. And how strong is that franchisee? And typically there's no real way to publicly give a credit rating to these types of tenants. That's why we call them non-credit tenants. But with all that said, there is potential that that non-credit tenant is equally as strong as a credit tenant. We've seen some franchisees that are multi-billion-dollar companies. And so it's just understanding what that underlying lease guarantor is when you're looking at your tenant. And there's pros and cons to both. You know, on a credit tenant, your cap rate might be much lower than a private or non-credit tenant where the cap rate's higher. So you have this risk reward that you're trying to understand as you're evaluating the different options. If you're going to utilize a debt component on your net lease, you may want to consider having a stronger tenant if they're non-credit, but having a stronger balance sheet. So what are the risks associated? A lot of people don't talk about the risks that are associated with net lease properties. They go into all the potential advantages, the mailbox money, but the real reality of everything is there are a lot of risks associated with net leases, and that's tenant risk. Like we mentioned before, a tenant default. We've seen even credit tenants, investment grade tenants default on their lease. And how does that impact your value? Probably significant. You have economic risk. COVID, uncontrollable, affected the different economies or regionally, different economies that were maybe locked down versus others. And how does that affect the tenant? Are they able to pay rent? Do they ask for a rent reduction? There's lease renewal risk and lease burn-off risk. Those two, I think, are your biggest risk factors outside of like a tenant bankruptcy, because they sign a 10-year lease. No business generally can predict where they're going to be at 10 years from now. No one can predict how that particular property and location is going to perform 10 years down the line. And it's the same case when we're looking at deals. We can't predict that. If anybody is predicting that, you should ask questions. And so you want to understand the downside risk. If this tenant was not to renew, who could I get in there? What kind of concentration risk do I have? Is it worth putting all my eggs or a large piece of my net worth into that net lease property that does have a high renewal risk? And then the lease burn off risk is another one, because a lot of investors that we speak to that want control, that control is, I want to be able to sell my property whenever I want. That's one control factor I want. And that's why I like net lease properties. Well, there's always an exception to the rule, but if you have a 10-year lease with a tenant and it gets down to 6 years, there's probably erosion of value there. And the way that you can get that value back is when you renegotiate another 10-year lease or another 15-year lease. But if you have to sell at 6 years remaining, there's a good chance you're going to take a loss. And so you want to understand that. You want to understand that lease burn off risk. And there's certain scenarios where maybe in a very strong primary market, maybe with very significant rental increases, which is rare, but if there's that built into the lease, then maybe that offsets a little bit of that burn off risk. But I do like to highlight that because that is a major long-term item you need to keep an eye on. The debt risk, understanding what kind of risk debt comes. A lot of 1031 investors take on debt to either have a large purchasing power. If you only have $1 million of equity, there's not a lot of options of quality out there. So you might take out a loan so that you could buy the $2 million, the $2.5 million property. But what is the refinance risk? If you're buying a net lease property with 10 years, yes, today you might be able to get a loan. But when that lease is coming up for renegotiation 9 to 10 years from now, and then you also have a debt coming due that needs to be refinanced on your apartment building, you might be used to that every 5, 7, 10 years you're refinancing the asset and it's easy or it's been easy. But now with banks being more conservative because of the economic environment, and then also a bank looking and going, I want to refinance you, but I don't know if this tenant's going to re-sign their lease. So you're up against this wall of trying to convince the tenant to re-sign their lease with a new tenure so that you can go either sell the asset and hopefully have some appreciation and don't have that burn off risk, or so you can get that lease extension so you refi. There's just so many moving parts, not to mention that during your hold period, there are store closings. I've seen all sorts of net lease properties out there. They might have a 10-year lease, but they shut down or go dark, is what we call it, meaning they might have 6 years left on the lease. They have justified, we're shutting that location down. We'll still pay the rent and honor our lease that we signed for the next 6 years, but that's less cost than keeping this store open. And if you have a dark or shut down store, even though you're receiving rent, you have inherently, most likely, lost a significant value. And now you're sitting there trying to work with the tenant to renegotiate a buyout, trying to work with the tenant as they may be trying to sublease the asset. And who knows if the lease allows, who they allow to sublease to. There's so much out of your control. Then you have the tenant bankruptcies. There are big companies that do go through restructuring, and we've seen it. There's always outliers. Hopefully that doesn't happen if you're targeting, some of the largest companies in the world, but it can. I would say you're more likely up against the stores going dark because these multi-billion-dollar companies can afford to shut down locations. And again, that's when you want to look at yourself and go, or look at your situation and go, buying this $5 million net lease property, how much does that represent of my net worth? Do I want all my eggs in that basket? With us at Kay Properties, we are fortunate to work within the DST, the Delaware Statutory Trust Structure, where we buy the same type of real estate, the net lease structure, but it allows our investors to diversify and take little pieces of the CVS or the Walgreens or the FedEx and not have all their eggs in that one basket. God forbid you have a store closure or a tenant bankruptcy or a dark store, and you can have less concentration risk. There's obviously still risk within what we focus on at Kay Properties, but that is a item to consider when you're looking at triple nets, is that concentration risk. So another thing is I like to go over with investors is the process of purchasing a net lease. I'm going to go through this fast for the sake of time, but please feel free to request this presentation via PDF or PowerPoint. I'm happy to share it. And this is a general overview. There's always maybe things you might not do, or you might do extra that I'm not showing here, depending on the particular property. But I do like to just give this overview because it is a lot of times different than when you buy a multifamily deal or the single family house that maybe a lot of investors are used to purchasing. So number one, you're looking for your property. You're identifying that property and that tenant. That's a little work that you want to go through. Then you submit an LOI. So in this world, it's a letter of intent. You don't go straight to PSA because purchase and sale agreements are usually customized by the seller or the buyer's attorneys on each and every deal. There's not like a template uh, uh, real estate brokerage PSA that a lot of times maybe some single family homes have, and some when you're buying a fourplex or a small commercial building. And so you do a letter of intent because that just gives high level terms so that you and the seller can come to high level terms without spending too much money on a legal team to negotiate that PSA. Then you spend money again on the legal team negotiating the PSA. Then you spend money ordering third party reports. Typically on these types of assets, it's highly recommended to get environmental reports, property condition reports, zoning reports, and survey appraisals, and then waiting the 2 to 6 weeks to get all those back and review them. And hopefully you don't find out there's an environmental issue, or when you were doing a lease audit, there's something in there that maybe was misrepresented in the broker's OM, and now you have to consider that piece. And so that's all your review of the due diligence material. And then you go back to the seller and negotiate and address the repairs that you discovered, and negotiate credits if there was something in there that you feel doesn't justify the price anymore. You submit title objections, you conduct tenant interviews when you can, calling or doing mystery shopping on the asset. And then you move to final closing documents and securing your insurance, which is also a whole nother animal that a lot of people don't understand. Is although the tenant might be responsible for paying insurance, the lease may say that you have to take care of it. And then you got to make sure that with your leasing or your insurance team that you're properly naming the tenant's entities, or if they're taking the insurance policy, that you're properly being named. And so the point of this is there's a lot of moving parts when purchasing a net lease asset. It's not just, hey, I want to buy that Walgreens and I sign a contract and 30 days later I close. You are owning a piece of real estate just like you did with your apartment building. And it's usually net lease, I find over the last decade, is a newer asset class or a newer structure of real estate to a lot of investors out there. And I think that one of my theses is that the mainstream investors, like on the retail front, basically individual people that are exchanging into net lease properties, this is newer over the last 10 to 15 years. And a lot of these leases out there on these net lease properties are 20, 15, 10 years, which means the world has not come up against that lease burn off. I think over the next 5 years, with all this debt coming due, with all these leases coming to renewal, companies restructuring and looking at their bottom line, there's going to be a lot of net lease owners out there that are going to go through headaches. And if you had concentration risk, that's not going to be a fun situation. So again, if you invest in net lease properties, unless you are already highly diversified in your other holdings, I would strongly consider other asset classes and or a more diversified approach like DSTs that we focus on. So I mentioned here a few times, there are management responsibilities in all net lease properties when you're the landlord. And if it truly is 100% triple net property where the tenant is paying for everything, they're never calling you for anything, your responsibility is lower, but you still want to have regular property inspections, whether that's by you or hiring somebody, because you want to make sure that tenant is fulfilling their lease obligation. You don't want them kicking the can down the road of some repair on the roof or AC, because remember, in the corporation's eyes that is renting from you, if I sign a 10-year lease and it's a relatively new building, I was fine signing that triple net lease because I probably won't have that many issues go on, because it's a new building, it's a new roof. But there are leaks that happen. There are issues with the AC that may happen a couple years in. And I may just put Band-Aids on that. I don't want to replace the entire roof because I know that my lease is coming due within the next 5 to 10 years. If I can just put Band-Aids on, then when I go back to the landlord, the building owner, I can use that as part of my negotiation. Hey, I'm willing to sign a 10-year extension, but our roof's getting a little old. we want to convert this triple net to a double net now, or we want a new roof, or we want you to do these repairs. So that's why you want to do regular property inspections, whether you are hiring a third party if you're not close to the asset, to make sure that they're following the lease obligations. You want to have those tenant communications. You want to review that lease to make sure that everything is falling in line so that you don't have any curveballs coming up 5 to 10 years from now. You want to have financial management. So some net lease structures out there are on a reimbursement. So you may pay property taxes, but then you have to reconcile with the tenant per the lease. You might, send a budget every year, and then you may reconcile and invoice the tenant for property taxes or insurance. And then you want to understand what is the risk management and property insurance on the asset. Owners need to understand the lease, what is required by the tenant, especially if you're the one pulling out the insurance and naming the tenant. And all leases that I've seen, at least with a lot of major tenants, there's always something in there that will give the tenant an out if there's enough damage on the property. So if the property is completely wiped out, some leases will say, hey, if you can't rebuild or bring the property back up to par where we can operate, we can break the lease after 12 months or whatever it may be. So again, if you have a really bad catastrophic issue at the property, whether it's fire, flood, hurricane, wind, and the tenant can't operate there, and then they get out of their lease, now you have an empty building. And what if you had all that concentration risk there? Because it can happen. God forbid it doesn't, but it can happen. And so then you dig into the property maintenance and repairs. Going back to, are you actually the one coordinating all this as a landlord and then just getting reimbursed? Because I manage hundreds of millions of dollars in net lease properties myself, and I will tell you, almost on a weekly basis, we get phone calls from national tenants. These are tenants that you would probably perceive that would be in a triple net structure, where they're calling us on a Sunday. I got a call this past Sunday for a roof leak. And yes, we had a warranty on it, we sent out someone, and ultimately we wouldn't have an outlay, but I'm dealing with that on a Sunday. And I think that's what a lot of investors are trying to get away from. I would understand your leases and renewals and vacancies in the market and talk with your brokers on what that looks like, because a lot of landlords don't realize they're probably going to have to spend some sort of money or give up some sort of free rent when that lease comes due. So in 10 years from now, when you're negotiating that lease, do you have to give them free rent? Hey, you re-sign a 10-year lease, I'll give you 6 months free rent. Or the tenant may say, I'll sign a 10-year lease, but I want, like I mentioned earlier, my parking lot redone, or our ACs replaced, or our roof repaired or replaced, or I want a budget for TIs, tenant improvements, because we're going to update our interior. And a lot of tenants may not have that amount of money. You also might have to pay leasing broker fees, because maybe that extension, that 10-year extension, there's a tenant rep broker that gets 6% on the total lease value, or whatever the market rate is at that time. So the moral of the story is there could be hundreds of thousands of dollars at risk 10 years from now. So you got to calculate that in. Yes, you might be buying X cap rate today, but how much money are you going to pay in the future? And then what is that true cap rate? And, for us, when we're doing DSTs and we're managing this, we take the same risk, and we're up against renewals, we're up against lease burn off, we're up against spending money on the tenants, but our investors are generally diversified. So if a curveball comes, our investors are not affected to the same degree as if they went and bought that property all on their own. And that's where we lead into what are DSTs. I've mentioned this a few times. I've mentioned about avoiding concentration risk, and I've mentioned what is really 100% passive out there. DSTs are probably the closest to a passive investment that you can get. Probably the only work you're doing is communicating with investor relations teams, getting updates when you want, getting up quarterly reports from the from the managers, doing your own taxes. But in regards to the actual management of the assets, they truly are 100% passive to the investors. And the DST is a structure that the IRS has qualified for like-kind property. It's a wrapper around the real estate. So there may be a FedEx facility that is structured inside a DST and allows 1031 investors or cash investors to come in on a fractional ownership basis. And this allows our investor that had $2 million to maybe get involved in, let's say, 10 different net lease properties across different geographical regions, different tenant bases, really trying to diversify in all different categories to mitigate as much risk as possible. But again, some investors out there go, I don't want to be, my primary goal here is not to be a fractional owner. I want to own something 100%. That's fine. So what we do is we help investors, because of that 45-day time frame, have a backup plan or a cover for their 1031 exchange when utilizing DSTs. So you might be going down the road of buying a triple net property, but you might be in your 45 days. You might not have identified that triple net property until day 20. And then just a few weeks later, you have the 45-day window where you have to identify. And what if you don't have all your third-party reports back? What if you haven't fully negotiated the PSA? What if that entire checklist that I provided you earlier, those aren't all completed? You're taking some risk in identifying that property, and then a skeleton comes out and you have to back out of that asset, or maybe you don't get the financing that you thought you were going to get. So, in the 1031 exchange identifying, you can do 3 different identifications, which is the 3 property rule, or you can do the 200% rule, which provides identifying however many properties you want, but it just can't exceed 200% of what you sold for. And so this allows an investor to put in DSTs on their 1031 exchange identification list. That's just a backup. And I'm telling you, as a firm, we run into this annually where something happens and that primary property falls through, and you either face a very large tax consequence, which you may be comfortable with, or you have the DST as the backup. And so there's no hurt, there's no down payment, no money out of your pocket to identify a DST. I do like to disclose, don't identify any DST out there without making sure you have a reservation with us. But it's very easy to do if you're comfortable with the DST and the risks that may come with that. And that's what we're here to do is provide that education. And then there's the cover for the 1031 exchange, and that may be, you might have a $2 million exchange and you find a perfect net lease that checks all the boxes at 1.8 million and you have $200,000 left over. You can buy the net lease property on your own and then use the $200,000 to cover your exchange. And then your aggregate value potentially gives you a full tax deferral in that 1031 exchange. And, we've done this on many occasions, from very small pieces to very large pieces. Maybe, we worked on a very, very large, I think the investor, don't quote me exactly, had over $100 million exchange of equity. They ended up buying a large chunk of assets outside of our firm, and then they used about $30 to $40 million with us to cover their exchange. So there's very large institutional style investors that utilize the DST for their 1031 exchanges, and there's very small investors to $25,000. And the beautiful thing on our platform is we work with all levels of investors. So what are the benefits of using DSTs if you decide that's a structure that you're comfortable with? Flexibility. It allows investors to get into properties that might be investment institutional grade properties that might be larger, right? You might buy a big logistical center that's operated by Amazon or FedEx, but that might be a $20 million asset where you might only have $1 million or $2 million exchange or $10 million exchange. It allows you to get access to potentially a higher quality piece of property, and also diversify those funds across different asset classes, because you may still want to have multifamily in a portfolio or self-storage, but you want to be a passive investor. So you've kind of taken that out of the picture. Well, in the DST structure, we have all sorts of asset classes that we work with. There's certain asset classes we won't work with, but a majority of the core asset classes, multifamily, self-storage, industrial, medical, and then your typical net lease. And it gives you access to have those options at a fully 100% passive approach. And then the professional management in the DST structure, there's an asset management team that is doing all those day-to-day management activities that I mentioned earlier. And I think that the DST structure has really become more popular over the last 5 years because the real estate market and tangible assets have become more expensive. And it's been harder to find quality inventory out there. And so getting access to this institutional vertical as a retail investor or a smaller investor has been very provided a lot of advantages. I do like to say, as I mentioned earlier, there still are all the various risks. Investors could lose money, they could lose cash flow, they could have, a very long-term investment horizon. These are all things that you'll have to consider, but you do get that diversification, which does arguably mitigate all of that risk. And if you visit kpi1031.com, you'll be able to register there, talk with one of our advisors. We do only work with accredited investors and accredited entities. We can, talk with you to verify if your entity is accredited and or if you're concerned or have questions on how you qualify as an accredited investor individually. We are happy to walk you through that. But if you visit kpi1031.com, you can create a profile and get access to all of our educational information. We have webinars every week, and we have a great book that we published and a quarterly magazine that just kind of goes over the industry and has various case studies and educational pieces. We do really appreciate reaching out to us, as our team is very focused on educating our clients and building a relationship. Again, kpi1031.com. We appreciate everybody joining in here.